Hey everyone, and welcome. Think of me as your personal, highly caffeinated UI team lecturer, and today we're going to turn your screens into a totally vibrant, good notes-inspired study session. We're diving headfirst into MAF201, specifically process costing. And honestly, I promise you, by the time we wrap this up, process losses and gains are going to be fun, straightforward, and crystal clear.
Here is our game plan for today. We're going to cover what process costing is, how it compares to job costing, and the overall factory flow. Then we'll get into the actual process account format, how to calculate normal losses, and we'll finish up with some crucial exam tips and a quick summary. It's basically your step-by-step roadmap to acing that final.
All right, Section 1. What is process costing? Let's lay down some foundations.
Okay, before we even think about doing any math, we need to know what kind of manufacturing environment we're actually looking at. By definition, process costing is a method we use when standardized, completely homogeneous goods are produced in a continuous series of processes. So what does that actually mean? It means we use this method for absolutely identical items that are made in a continuous flow. They move seamlessly from raw materials into finished goods. We are definitely not talking about custom, one-off orders here.
Picture a continuous production line in a real-world factory. Every single product coming off that line is completely homogeneous, meaning they are exact clones of each other. The factory just keeps running based on broad sales forecasts rather than waiting around for a specific customer order. As the product moves down the line, we meticulously accumulate costs in each specific process. And to find the cost of just one finished unit, it's easy. We just take the total accumulated costs and divide it by the total units produced. Just remember, any expected normal losses or unexpected abnormal losses are always factored right into our finished goods.
Moving right along to Section 2, job costing versus process costing.
Grab your highlighters because this comparison is a super common exam question. Think of job costing like baking a massive custom 3-tier wedding cake. Every single job is completely different. The costs are compiled separately for that one specific cake. You don't transfer frosting from one custom cake to another, and honestly, it's pretty hard to control. Now, process costing is entirely different. It's like a factory bottling thousands of identical fruit juices. The products are purely homogeneous, costs are compiled over a period for a specific process, there's a continuous flow of work in progress, and because it's so standardized, it's way easier for management to control.
Okay, Section 3. The factory flow and continuous production. Let's see what this actually looks like.
To really visualize this, imagine we're taking a virtual field trip to a massive juice factory down in Perak. Let's call it Juice Best SDNBH. Picture this brilliantly clean, standardized factory floor. Workers are in their protective gear, and over 5,000 bottles of fruit juice are continuously moving through these different stations every single day. That constant, unstoppable movement, that is the beating heart of process costing.
Let's trace the journey of that fruit juice step by step. Step 1 is the mixing process. That's where direct materials like water, refined sugar, and juice extract are combined in huge vats. Step 2 is the bottling process, where those cleaned and sanitized bottles are filled up and capped. And finally, Step 3 is the packaging process, where the filled bottles are carefully inspected, beautifully labeled, and boxed up to become finished goods ready for retail. So the absolutely crucial point here, the golden rule, is this. The output of one process becomes the input of the next process. The perfectly mixed liquid from process 1 becomes the starting raw ingredient for process 2. Remembering this flow is the secret to getting your math perfectly right when we start crunching the numbers. Which brings us to Section 4, the process account format, also known as your best friend, the T account.
Let's step off the factory floor and open up our accounting books. This format is basically your most important weapon for the MAF201 exam, so study it carefully. It's set up as a standard T account, and it is beautifully logical. All your inputs and costs, like direct materials, direct labor, production overhead, and any abnormal gain, those all go on the debit side. That's your left side. Then, on the credit side, the right side, we record all our outputs and the losses. This includes normal loss, completed units transferred out to the next stage, closing work in progress, and abnormal loss. Seriously, burn this structure into your brain.
All right, Section 5, normal losses, or as I like to call it, expected wastage.
This is the most frequently tested part of the syllabus, but don't panic, we're going to break it down. What exactly is a normal loss?
Well, it's just expected, entirely unavoidable wastage that management estimates based on past experience. For instance, if you're boiling fruit juice, some of that liquid is inevitably going to evaporate. Or maybe there's minor scrap from rejected labels. It's completely normal, it cannot be totally eliminated, and because no factory is perfect, we plan for it.
Time for a quick pop quiz. Let's get those mental light bulbs glowing and see how expected losses actually affect our final factory output. Here's your scenario. Say we pour 200 kilograms of raw material into our big mixing machine, but based on past experience, we fully expect a 10% normal loss. How much actual output are we expecting to successfully get out of that machine? I'll give you a second to run the numbers in your head.
Did you get it? The formula is super simple. Expected output equals input units minus normal loss units. So we take our 200 kilograms of input and we subtract that 10% normal loss, which is 20 kilograms. That means we realistically only expect a final output of 180 kilograms.
And this beautifully sets us up for our master formula for finding the cost per unit. The cost per unit equals the total input cost divided by the expected output units. Now listen closely, because a really common trap is dividing by the raw input. Always remember to use the expected output, that 180 kilograms we just calculated.
Let's put it all together into a real Process 1 account. On our debit side are inputs. Materials are 200 kilos, costing RM 3,500. Labor is $2,000, and overhead is $1,340. So our total input cost is exactly $6,840. Now, over on the credit side, we record our 10% normal loss, which is 20 kilos. But notice the total RM cost for normal loss is just a dash. In this specific scenario, it absorbs no cost because it doesn't have any scrap value. We can't sell evaporated juice, right? So the entire RM 6,840 cost has to be borne by our 180 kilograms of completed output.
So, let's do the final math. Take the total input cost of RM $6,840 and divide it by our 180 kilograms of expected output, and we arrive at a perfect RM 38 per kilogram. You just completely conquered a full process account with a normal loss. Seriously, fantastic job.
And we've made it to Section 6, Exam Tips and Summary. Time for the final review phase.
I see students fall into the same traps every semester. So as your lecturer, I want you to remember these pro tips. First, always subtract your normal loss units from your input units to find your expected output. Second, never forget that the output of Process 1 immediately becomes the transferred in input for Process 2. Third, memorize that T account format. Debits for inputs, credits for outputs and losses. And finally, read the exam question very carefully. If the normal loss does have a scrap value, you absolutely must deduct that scrap revenue from your total cost before calculating your cost per unit.
Let's do a rapid-fire summary to lock all these concepts in. Process costing is designed for continuous manufacturing of identical items. Normal losses are completely expected, natural factory wastage, and they absolutely must be subtracted from your inputs to find your true, accurate cost per unit.
I'll leave you with this final thought. Every expert was once a beginner. You've tackled a major, challenging topic today, and you should feel really proud. Keep practicing those T accounts, and good luck on your MAF201 exam. But before we officially sign off, think about this. If normal losses are completely expected, how do you think our accounts handle the unexpected, abnormal losses when a machine suddenly breaks down? We'll leave that mystery for you to ponder until our next session. Catch you later.